Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. I was like totally not ready that time. I thought I had more time to dab my eyes and get all ready and everything. Okay, guys, hey, we got some relatively important numbers, and gotta warn you today, this, because we're going into holiday this weekend, people are gonna trade it real fast and then go. So this could be like a wild ride at the beginning and then calm down very quickly. Let's go to the charts. So the treasuries popped pretty hard off of those numbers yesterday. I think the big thing that they were looking at was like PCE and GDP numbers, but they were ignoring the employment numbers and everything else. It did eventually come almost all the way back down. We took a little bit of it out of here, but weren't really able to make much. Much later in the day, it did go down to where I was kind of hoping. So here in the overnight, we've retraced a little bit of that. So I would call this a little bit of an inside day. S&P 500, you can see here, after that huge downer day the day before, they were able to claw quite a bit of it back, and they may actually end the week on the highs. Wouldn't surprise me. Oil is still just kind of trucking along sideways, though. Gold and silver took a little bit of a jump off of that yesterday because the market just overall expects interest rates to decline. And we got the Japanese yen and the dollar coming all the way back down to 101 now. I tell you what, because we were like at what, 106? That's a pretty big win for dollar shorts if you were short the dollar. And we got Bitcoin. Bitcoin has come up to the higher end of its range. It's going sideways. I'm seeing a lot of headlines this time from Fox, pretty reputable outlets that really strongly suggest that a Bitcoin ETF is going to get approved. And, you know, some people are like, maybe it will be a sell the news kind of event. I don't think so. I don't think I want to be the one saying, this will be like the end of this particular rally. And then I don't think it's just quite the same with the ETF, but we'll see. I just don't want to touch it. Okay, so we got a bunch of numbers coming in here. Core PCE, personal income, personal consumption, core durable goods, all coming out here in just a 30 seconds. All right, so let's just let them do their thing. They are pulling for the news already. I think they might actually get even later than that. Okay, two people jumping the gun. There we go. It's pulled a little bit more extensively. Here we go. Okay. Okay, so I'm seeing price index month over month negative spot 1 versus 0. And price index year over year 2.6 versus 2.8. So that is a little bit better than expected. I would expect them to be moving up off of that, but they're not. Durable goods was much higher than expected. 5.4 versus 2.3. And what about consumer spending? Consumer spending slightly less than expected, spot 2 versus spot 3, and personal income spot 4 versus expected spot 4. Real personal consumption spot 3 versus spot 3. Core durable goods spot 5 versus 1. So I think what we're seeing here is that the PCE numbers, the ones that we would expect to be like the most important, came in pretty close, slightly dovish, but the market maybe is paying more attention to those durable goods, which is unusual because that's a number that isn't typically a huge mover. But we are selling. It is a retracement of some of the overnight action. So I'm not entirely sure where it goes from here or how, to what extent it could come to the downside. But I would also say, I mean, look, if I kind of look at where we were, okay, it was an okay move. It wasn't a massive. It wasn't. I don't think that was nearly as big as yesterday, was it? So, you know, it could get tough real quick. All right, I'm a little concerned about what this says for the rest of our session. Might make trading a little difficult. That's actually probably good. So one thing I should mention is that I am watching the boys again. My wife works for the weekend, so they're asleep right now, but they may wake up before we're done, and then I'm going to have to go and watch them. I may just, you know, step out of the room, leave the stream running to capture the action. But again, this is like the you know, having Christmas on a Monday, Christmas Day on a Monday, that gives you a pretty awesome weekend. So I really think the traders are going to want to leave for the weekend. Well, they just pushed another 4 ticks there, and awfully quick too. There is like, the liquidity is still not back yet. Bring them to the stream. Well, we can sometimes, if I just have one of them, then we'll just sit and watch, right? But I'm gonna guess that I'll have both of them awake, and they will just tear the room up. I gotta figure out what we're gonna do all day, because, well, Mom will be back at like 4, but yeah, that gives me plenty of time. We could go do something. I can't imagine what we could do. I think the first thing is I gotta clean the house. I gotta listen. If I'm gonna be the stay-at-home one today, right? I gotta show her up. She's gonna come home. Everything's gonna be as clean as I know how to make it. Just isn't very clean, but better than it is right now. You know, maybe have started laundry and things like that. I think I will wash the bed sheets. She's gonna come home. She's gonna be like, oh my gosh, you did Top Golf last night? I haven't been there in a long time, man. I'm trying to think about when was the last time. Well, no, I've done it since COVID. To be honest with you, I am not very good at golf, man. Not that I've ever put a ton of effort into it. But this is one of those questions that I kind of ask myself. This is one of those things I'm kind of like putting off. Is like, okay, I'm doing pretty well for myself on my own. In order to get to the next levels, you kind of need to network and stuff, right? So that means that I need to start frequenting rich people places, building connections, making friends that will let me manage their money for them, that sort of a thing, right? And where do you do that? Well, it used to be that you do it with golf, but it doesn't seem to me that millennials do that. So what is the rich hangout place for millennials? I don't know if we have it. And even if we do have it, they might not have it here in Utah. So maybe I should just remain a hermit and stay inside all the time. I have a little bit of food, so I'm going to eat some food here, but you tell me what you think of that. Join a country club? But that's golfing. This is the whole thing. Is I kind of seems to me that country clubs are on the way out. That when the boomers are all gone, that there won't be enough millennials to sustain them, and they will tear them down and build houses there. Maybe I'm wrong. Maybe millennials get into it later. But it seems to me like country clubs are on the way out. Okay, Adam asks, have you ever known anyone to have trouble withdrawing from any futures brokers, especially NinjaTrader, meaning they did not want to pay the money out? Absolutely not. And any situation where a registered FXCM would not pay out when you try and withdraw your funds would be a complete shock to me. So to be an FXCM, you have to maintain $1,000 in excess capital. So there should never be a situation where they don't have the money to pay you out. It should never happen. Now, you might have problems with like, the method that they use to, I wouldn't say that the methods that you have to fund and get paid back are always the best. Like, I remember when I was with, who was it? AMP. When I was with AMP, I always had to send them a check because their direct deposit and stuff didn't really work. Or I didn't want to pay the fee for it. I forget what it was, but, so there can be those sorts of things. And maybe your, what do they call it? HCM transfer method might be having technical issues. But the broker, like, not paying you out because they don't have the money absolutely would never happen. Like, something is very seriously wrong if that happened. How long is the activation process when we purchase your indicator suite? That is all manual, so it just comes down to when I get to it. So I can do that right now. Pull up my camera here while I do that. Usually not a huge deal though, because you do get like the 2-week trial with it. So usually when people, go and buy it, they're not through their trial yet. So it shouldn't stop working on you. What I'm saying. Let's see. But I do remember getting an email last night. Oh, they seem to be settling pretty happily at 23 here for the moment. Oh, you have to send me your well, maybe it'll show me over here. It's not showing me the hold on. Not showing me your ID. What? Oh, I know why it's okay. I'm being dumb. That didn't sound very good. You're available at my live. No. We're gonna be gone next week. You can watch replays. No, I'm just kidding. Dude, I'm so sorry. That's like the worst time for somebody to die. Here it is. I don't know why eBay keeps changing the emails, so I couldn't see the machine ID. There you are. You started it a long time ago. I gotcha. Okay, you should be good now. There you go. I took longer than it should have. For some reason, it wasn't. I had to do an account recovery there. Kind of weird. Trying to be good, changed mood. Yeah. Could be worse. I mean, when my sister died, I basically just said I'm not going to trade for the whole month. Right. So I kind of burned myself on my arm, and thought it was a small burn, but it's not healing very well. It must have been more serious than I thought. There's somebody in Discord that is like, they're trading on Sim, and they're like, oh yeah, I'm trading on Sim, and I'm having these days where like I lose $3,000 to $8,000 every day, and I'm like, well, that's because you're trading NQ with multiple contracts. That's probably not going to work. Start small. It's pretty crazy to me how, I mean, I really spend a lot of time trying to make sure that I have all the information that's available on here so that beginners know where to start and don't fall into these traps. But I still see the majority of beginning traders fall into these. And one of the two most common, I think, are over leveraging at the start and taking on more risk than reward. I think part of it is because we do teach a lot of there are people out there, they will teach things like, okay, hit in with 3 contracts, and then you have one contract you'll take off at 3 ticks, then another one you'll take off at 8 ticks, and then another one you just let ride. And if it goes like 4 ticks against you, or maybe 5 or 6 ticks against you, then you get all out. And you realize that, like, okay, if you get like your second target, that's like equal to what you would lose if all 3 of your contracts stopped out. Now, hopefully you don't stop out on all 3 of your contracts, but basically once you get a fat tail, that system doesn't work. So you got to realize that the reason that system can make you money in the short term is because it is taking on risk. It's taking on risk, and you're making money purely from the taking on risk. And if you don't actually have an edge behind it, then eventually that's going to blow up in your face. And the people sharing those kinds of sizing strategies aren't telling people that. And you got me for trade because my friend says I need to start trading ICT. Well, I have a video about that. I have a video where I back test his primary strategy, and I show how it was making money for a time probably because of how popular it got on YouTube and that it doesn't make money anymore. And then I have a bunch of people telling me, well, but there's just people doing CFD, contracts for difference. How can that affect the market? Well, I don't think that it's just people doing contract for difference, but I'm just showing you what the back test shows. Soon as the channel took off on YouTube, strategy stopped working. It's like literally to the day. There was this day where for whatever reason, some video, I can't track down what it was, but some video on his channel blew up and made him very, very popular on YouTube. And that was almost the exact day this strategy stopped working. So I don't think it's quite that. So you say the more popular a strategy is, the less edge there is. It's a little bit more complicated than that. It's actually more like this. If well, let's pull this over here. Put kids over there so that I get to my pad and draw pictures. This is where I wish I had more room on my desk. You know, I have this little like temporary disc set up behind me just because we have that in the other room, and that's where the Christmas tree is right now. But I'm kind of liking it now. I'm kind of like, maybe I should just get a really nice executive desk and have that there all the time. Okay, so we're going to draw a graph. And if we were to say the X is how popular it is, and to be popular, and the Y is profit, it's something like this. Being a little bit popular actually helps the strategy, and then it very, very quickly destroys the profitability of it. So what happened with smart money concepts, I think that you know, it's kind of a buy the dip strategy, to be honest with you. Like when you really look at it, it is a really, really complicated way of saying buy the dip. Okay, so if you buy the dip post-COVID, probably it's going to work. Okay, but so what happened was his YouTube channel was starting to get popular, and so because some more people were trading the pattern, it did seem to help it and move it a little bit, right? But then once it got too popular, once it got to the point that the YouTube algorithm picked up on it and like started pushing it out, because like seriously, it was like an insane jump. It's like all of a sudden this guy goes to like hundreds of thousands of subscribers. Okay. And as soon as that happened, now there's too many people trading it, and like the market sniffs it out, or other, you know, maybe there are hedge funds watching for this sort of stuff, but it just completely stopped working. And it's like, go watch the video because I show you the chart. It's just like all of a sudden at this one point, it was like it won every time, and then all of a sudden they never won. It's like square root law applied on you kind of, I guess, yeah. I would be very interested to see what the actual statistical properties of it would be. Like, what is the formula that we would draw to express, you know, how the popularity versus the profit of something? Surely there's a pure point at which it kind of like evens out and then just turns into a you know, break-even trade, or just random, right? What Seth, price action technical analysis cannot work too? Well, I'm not saying that the reason this made money during this period was because it was an effective technical pattern that predicted something in the market. I think that this worked because people were trading it. You had enough money chasing after it that it was moving the market in that direction. Yeah, the inverse sine law. So, yeah, I think that you probably could like Like part of what I was trying to make with that video was showing you, like, look, researchers for the longest time have always been saying, we think that if you have a technical strategy and people start trading it, that it removes it from the market. That because of market impact, when you get too big, it destroys the strategy. And so they've done all of this work to, figure out how to size themselves appropriately so that they don't destroy the edge. That's what happens at places like Renaissance Capital. So we've always kind of had this theory about that this is the way that the market has, and I think that there's a really, really solid amount of empirical evidence supporting that theory. But this, I think, proves it. I think that this is a case study showing it actually actively happening in real time. And I think that you can go through and look at YouTube and say, what is the most popular thing on YouTube now? Okay, so like if smart money concepts dies down and is less popular, what is the popular retail trading strategy, technical strategy that replaces it? And do the same analysis on that and do it over and over again. And once you've done it with a number of channels / strategies, you have enough data to put out a study to actively prove that when a strategy becomes public, it being a little bit popular helps it, but too popular completely destroys it. And then we would prove it once and for all. And then, maybe people in the media and on TV would talk about it, and people wouldn't believe in technical analysis that they saw on YouTube anymore, because they would understand that the fact that they're seeing it on YouTube means that it won't work anymore. Now, what we do is different, because what we're doing is looking for informational inefficiencies. So what those informational inefficiencies are changes every day. So having a lot of people watching my YouTube videos wouldn't really matter. Now, having a lot of people watching my live stream, that might matter. But I don't think that it would become a problem until we're, over like 150 viewers or something like that. I'd rather find something that works for myself quantitatively. Well, there are things about a quantitative strategy that are very, very desirable. So if you can find one, it's absolutely in your best interest to find one. It's just what it takes to find one. I don't think we realize what it takes to find one. Like, one of the problems is that, when all you have is a hammer, everything looks like a nail. And that's a lot of what I do when I'm like backtesting stuff in NinjaTrader, right? It's indicator soup. I'm taking indicators that I have and I'm combining them together in a way that I think might find some edge in the market. And what do I find? Most of the time they don't work. And when they do work, the edge that I find in them might be super, super tiny, And it's only in combining like a bunch of these teeny tiny edges together that you actually get something that kind of works. Meanwhile, you go over into the quant world and the things that they're using are completely different. Like, they're doing things like this matrix math sort of stuff to figure out how correlated or co-integrated something is, right? None of your platforms include that stuff. Right? That's really, it's not, I wouldn't quite call it machine learning, but there's kind of like these advanced statistical methods that involve advanced calculus. And to use, you need, to really use effectively, you need to bring in other frameworks. So for instance, I have a co-integration indicator on here. The reason why I don't include it in my indicator suite is because I would also have to include this math library. So it just doesn't work really well to giving it to other people, right? So maybe someday there'll be a platform that will include like by default access to these, like a platform where your programming is based in Python, and you just get access to pandas and MATLib and all that stuff right from the get-go, right? And then maybe you could include those things, and maybe retail traders would talk about them. But like they're on a completely different plane, right? And meanwhile, we're just trying to do like the analysis of price. It's going to be super hard for you to find anything. Okay? There you go. I've been doing a lot of research and considering going for an advanced degree in financial engineering or something like that. Yeah, that'd be great. I mean, that's what I wish I did. I wish that when I was done with computer science that I had turned around and started to get into more statistical stuff. That I wish that I had gotten into like the machine learning stuff 10, 20 years earlier. Not familiar with Tiger Trade at all. No. Okay, so Adam, when you answered your question earlier, did you mean the CFTC and not the FXCM? No, so I'm talking about your futures commission merchant. So you have your IB is your introducing broker. So that's going to be like Edge Clear, for instance. Okay, is your introducing broker. And your introducing broker is basically like your live support and sales, okay? And they connect you to the FXCM. The FXCM is the one that has an agreement with your data provider and all of these other things and to get access to the market. So the FXCM is your actual access to the market, okay? An introducing broker needs to have $45,000 in excess capital at all time. An FXCM needs to have $1 million in excess capital at all times. Okay. So, if you deposit money, your money is getting deposited to the FXCM, right? You withdraw money, it's coming from the FXCM. So, if the FXCM did not give your money back, that would be incredibly unusual and something's very, very wrong, right? Because they have to keep $1 million in excess capital. And if they can't give you that money, that they don't have that $1 million in excess capital, right? Like the thing is set up so that the thing that you're talking about will never happen. And so, yeah, at that point, it would be something like, oh, sorry, it's not FXCM, it's just FCM. Futures Commissions Merchant, FCM. I'm using the wrong FCM. Futures Commission Merchant. Yeah, you're right. FXCM was the name of that Forex broker, wasn't it? So Jamie says, meanwhile, same principles of supply and demand, trend following are what moves markets and will always move markets. People way overthink it. No, that's incorrect. So let me teach you the truth, though, because you're not completely wrong, but let me teach you the truth. Okay. First of all, I think that one of the things that you'll hear people say is the reason technical analysis works is because people never change, and they will tend to do the same thing over and over again, etc., 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 right? Well, the reality is people are actually really random, and people adjust to things very, very well as well. Okay, so supply and demand. Okay, so first of all, what is the concept of supply and demand as they teach it? They say that there are areas where there is demand for the asset, and there's areas where there is supply for the asset, and we'll bounce off between those areas, right? Okay. Well, so first of all, what they're doing there is they're taking terminology that comes from economics, supply and demand, and they're applying it to a chart in a way that is not supply and demand. Okay, so what is supply and demand? Supply is the people producing the good, and demand is the people wanting to buy the good. And the balance between supply and demand is, essentially determines what price is. Okay. But what is the force of supply and the force of demand in an actual market? And see, most of the people that you see talking about charts and talking about the stock market don't know anything about what a limit order book is and how it works. And so that's why they're using those kinds of terms, because when you understand how it actually works, you kind of realize that like trying to say supply and demand is kind of silly. So what do I mean by that? Well, so we have right here on the screen right now, if I can kind of highlight for you, this is one DOM I have over here. This is the 10-year treasury, okay? This blue column right here, those are limit buy orders, and this orange-red column are limit sell orders. So those limit buy and limit sell orders are matched up against market orders. So if I put an order in to sell at 29 right now, I will go at the back of the queue, at 1,000 in the back, waiting for my order to get filled. And in order for my order to get filled, somebody has to come through with 1,000 market orders, like just happened right there, and buy me out, and then I'm filled, right? So it's not really supply and demand. It's actually, you can think of limit orders as supply and market orders as demand. So it's really sell supply, buy demand, sell demand, right? These little arrows represent the market orders hitting into the limit orders, okay? It is the interaction between these four forces, and there's a fifth and sixth force, which are the limit orders canceling, okay? So it's the interaction between those six forces that are actually determining what moves price, okay? So, yes, you could see somebody come in and say, I want to buy it down in here. Well, what are you going to see? Well, they could do it a couple of different ways. They could have a huge iceberg right here, and you'll see like 10,000 contracts trade. And then there's not enough market orders to get through that. And so then price moves up and they chase it. Right? You could think of it that way. But you can see that like the terms supply and demand, they're misusing a term to describe something that is much more complicated than just supply and demand. Okay. And the thing is, when you kind of get into it, is like, okay, if there's like a big order there and somebody buys a ton of it and they get through it, it tends to go like this and come back up, right? It tends to like blast through it temporarily and then maybe get stuck there. So this is the first thing that will really mess people up and is probably one of the most useful things for you to know as a retail trader, okay? Is that a lot of volume occurring at a single place will strain the market makers. It will cause some market makers to not be able to put more capital up at that location. And so you'll end up with a place where there's not very much liquidity here, but there is liquidity immediately above and below it. And so it gets stuck in that area. And that's what we call a liquidity hole. Okay. Now, one of the great things about watching ZN is that these behaviors, and these are behaviors caused by like the actual structure of the market, not people's behaviors, but like actual mathematical properties caused by the rules of the game that are very consistent. And you can see these behaviors very clearly in ZN. It's like we just had news there, okay? And then we sat there for 5 minutes in a 3-tick range, which really isn't a 3-tick range. It's really like people buy it up here, they sell it down here, they buy it up here, and yeah, a few orders will trickle into this, but they're never able to break through this offer or this bid. How can that happen after the market being so volatile here for so long? How does that make sense? It's because it's a liquidity hole. They get stuck there. And the people, the professionals, they know this, and so they kind of wait. They kind of wait and try and get as much filled in that little area as they can. Okay. So, and that brings us to the next thing, the next problem with supply and demand. Okay. Which is, even if you can identify locations where people tend to want to buy it there and another location where people tend to want to sell it there and price can't get below that area and they can't get above that area, it's not a profitable strategy. And why is that? Because markets are inelastic. So what does that mean? Elasticity is a measure of how the supply and demand reacts to a change in price. So if we had a large move up in the price of gold, then presumably gold miners would want to mine more gold in order to take advantage of that higher price. And so that will increase the supply and bring price back down, right? So it's elasticity because it's like the further away you get, the more it will tend to pull you back down, right? Well, markets are inelastic, which is the exact opposite, which means that if you think of there being like a rubber band between my fingers, if I move up like this, the rubber band just stretches and it doesn't pull me back. It just makes it even easier for me to continue moving up. Markets are very inelastic. So trying to identify a place where you think that like it's going to hold or it's held in the past, there is more money to be made in blasting through those areas, in breakouts. So what we're doing is we're looking for things that can predict future orders. And I'm kind of relying on all of these naive retail traders to buy the dip there in that location or thinking that it's going to bounce there, when I know that the reason that they're selling is because of X news or because of, the time of month or rebalancing or positioning before the holiday or whatever it is, and that they're going to blow right through that. And then I make money on all of the retail traders, stopping out. And when I see them stopping out, I can take my profits. So supply and demand is a misuse. Don't use supply and demand in the context of market microstructure and trading. It's incorrect usage of the term. Okay. Talk about a limit order book. The second thing that you mentioned was momentum. So, or trending. Okay. So retail traders tend to misunderstand what is momentum. Well, because the market is very inelastic, momentum is a thing, which means that there are situations where when an asset is moving in one direction, it will tend to keep moving in that direction. So we think of it as like if, like a moving average, if they get above that moving average and then they continue above that, right? But if you go and you start taking those trades, you find that those strategies, they don't work. Like just off of a moving average, they don't work. And why is that the case? Well, because it changes direction all the time. And when is it trending and when is it not? There's not enough information just based on that it's trending alone to know if it's going to continue like that. So then how do these like momentum strategies, because there are people making money off of that, right? How does that work? Well, what they do is they trade a basket of assets. And what they do is they say, what asset has been up the most and what asset has been down the most, right? Because that asset is likely to actually have a real driver behind it, creating a trend that's going to keep it going, right? And by splitting it up between different assets, it actually kind of normalizes their returns. Normalizes is probably not the right word, but basically it increases your Sharpe ratio because one asset will be going down and another asset will be going up and so forth. Right? And that's how, quote, momentum works. So trying to say this chart looks trending, I think it's going to continue going on a single asset doesn't really work. You would need to know, like, why is it trending? So what I'm doing instead is, again, I'm trying to predict the orders. So I want to predict that there is going to be a trend before anybody sees it on a chart. I'm going to say, because, so a situation that we could maybe use today is that we do have a big holiday, right? So the first thing that I expected was that we would get a pretty decent move off of the economic news that we were supposed to get. We have consumer confidence in 45 minutes. Okay, so I'm not expecting a whole lot of volume until then. I think that we'll get another burst of volume in 45 minutes, and then probably things will die down very quickly. But you do have to be careful because sometimes going into a long weekend like that, they need to reposition themselves. I don't know what direction they would need to reposition themselves, but let's say, for the sake of argument, or let's just speculate. So I'm going to speculate on something. I don't know. I'm not very confident that this would move the market, but it could potentially move the market. And that is that there are a lot of longs in the treasuries. Those longs will probably want to take profits before the end of the year. And then when the new year starts, they might take completely different positions. So you might see some profit taking today. That could predict future orders. And if I'm correct, then maybe that means that there's like, 50,000 contracts worth of volume that will need to sell because of that. Now, I know what the future orders are going to be, and I know the empirical properties of stylized behaviors of markets in the order book and so forth. I can predict pretty effectively how that will play out. Yeah, it will play out in a trend down, but it's probably going to happen in waves because you run into those liquidity holes. You create those liquidity holes. So they'll go down until they create a liquidity hole, come back and settle in the liquidity hole, wait about 45 minutes, 30 to 45 minutes, then move down again. Right? And that's how we're doing it. Okay. So for something that that everybody says, oh, it's simple supply and demand, this and that, right? I just explaining what the actual reality of the market is based on the empirical data that we have today took me 20 minutes to explain to you. It's actually very, very complicated, and it is not at all what retail traders think. Can you see how it's kind of like a game of telephone? It's like because a lot of this stuff was discovered in the 80s. Like, it's been around for a long time, and retail traders just don't know because they're not reading the research. So some retail trader talked to their friend at a firm, understood this stuff, and he explained it to them. And then he explained it to another guy, and when it comes all the way down to it and it gets down to you, it's a moving average, when that's really not what they're doing in the professional world at all, right? See what I mean? I watched a lecture on market making weeks of micros. I would love to see that. What's the name of the machine learning book you would recommend? You know what? So I have a book by Matthew Dixon and Igor Halprin that is about machine learning and finance. And they go into all of this deep stuff about basically deriving these machine learning methods and the statistics behind it and everything. And it is so above my head. It is so above my head. So while I like the book and I think it's a good book, I don't know if it's a book that I can recommend to you guys. Because if I can't, just to be frank with you, I think I'm a pretty smart person. People tend to tell me I'm pretty smart. If I have a hard time figuring it out, then most people will have a hard time figuring it out. The book is probably only appropriate for if you are a graduate math program, right? That's what it seems to me. You have some background in statistics already. Then maybe it would make more sense. Now, there was another book that was popular before that, I think called Machine Learning and Finance. Let's go find it. No, that's the one that I have. That's the one that I have. If I go to Amazon, I think it's this one. I think I looked at this one. Advances in Financial Machine Learning. Because I remember this one having exercises and Python things that you could do that would show it, and example data and stuff like that. I hadn't when I tried this other book and it was not what I thought. Actually, let's look at that. I have over here. No, I put it in one of these things. Put it in my big archive one. Oh, here it is right here. Have way too many books in here. Machine learning for asset managers. What is this one? Oh, that's Ayer's book. Yeah, I remember this thinking that this one had like Python stuff and everything in it. And then I started reading stuff and it was like not. Well, there are exercises, but they weren't like what I wanted. Maybe I needed to get further along. I think I got to like the end of Bayesian regression and Gaussian processes, and I felt so lost. And then you get to the exercises and stuff. Like, let's go to page 106 here. Oh, this one has answers. Yeah, okay. Consider the Bayesian linear regression model, yada, yada, yada. How do you do it? And I would come to these and I would be like, I have no clue how to do that. But it's really hard to like read a book and then like read the equations and like understand them. Often I will like read everything else, come back and read the equations and then yada, yada, yada. Yeah. But you get what I'm saying? Like you have to treat it like a math class. There was another book, I swear I had another book that was not like that. But maybe it's this one. Yeah, this one seems to have there are Jupyter notebooks in there. I just didn't get far enough, I guess. Chapter 2. Oh, there is a... okay. I don't know. I guess I need to just try harder on that one. Still kind of this question in my mind about should I bulldoze through it and finish this book, or should I switch to something else? It's a little bit more my speed, because this book, it was too advanced for me. And there's plenty of stuff that's like once you get into I tell you what, a lot of the game is knowing the terms to search for. Because basically, it's like it's its own esoteric world that is completely disconnected from the world of retail trading, right? Because the people in this world, they want to work for firms. They want to work, for the big boys. They're learning this stuff at universities. This is not the same thing as the retail traders. Retail traders are the people that didn't... weren't good enough at math to go to those courses and stuff like that, right? So once you understand the terminology and you search for it, then you're not. So market microstructure is one of those things. That's the information I think is the most helpful to us. But, if you search for quantitative finance stuff and you search for like Python stuff, then you start to get much more practical things. Because then you get to where there's all sorts of tutorials written on what's that kind of super site that replaces blogs, and you can write tutorials and stuff on it, but you can only read so many a month. Anyways, there's tons of stuff on there that will walk you through. Like, I bet you. Actually, let's try and search for one. Programming momentum strategy in Python. Well, here is a video, Algo Vibes, where he talks about it, and it looks like he's going to write it in Python. So that would be pretty cool. Medium. Building a momentum trading algorithm using Python. Right? And then it should go through like... here you go. Python for algorithmic trading. Cool. And then it's going to go through this whole thing of like setting up a library of things and calculating what is up the most and what is down the most. And okay, what is their risk management? Maximum amount of money that I'm willing to risk per trade, or that I'm willing to lose in a day. Pretty simple. Really would like to find some more advanced risk management strategies. So that's the sort of stuff that I would search for. Yeah, I think the one that I'm thinking that I was interested in, machine learning in finance, Bob Mather. Might be him. Might be this one. It says that this is only 88 pages, though. There was a book that was the most popular book before Iger's book came out. Machine Learning Finance. I think it was this one. Advances in Financial... Ooh, I can get it for free in an audiobook, huh? So for that, it wasn't a audiobook. I don't know. There's a couple of different books. This is the book that I bought because I know these guys. Well, I found them on LinkedIn. Here's another thing. This is one of those things where I shouldn't tell you, but I'm going to give you a little bit of edge, because the way that I approach it is if you guys ask the right questions or it brings me to that, then I'm going to tell you. I don't necessarily want to be the gatekeeper. Look these people up and find them on LinkedIn. If you read their book, you have a hard time understanding something, or there's something really interesting you want to go deeper into it, and you want to know where they got their information, message them on LinkedIn. You would actually be shocked how available these people are. It's just like here in the retail trading world, if I sent if I sent the No BS day trading guy an email, I'm 100% confident he would respond back to me in a day. If I sent Futures Trader 71 an email, I'm almost positive that he would respond back to me. And any of these other people in the futures trading space, right? And I think that most people that have been around in futures trading, that you guys know that because you've tried it and it's worked, right? Well, these guys, this is the same thing. It's just that they can't really talk to you on YouTube, right? They have rules that, Igor, he works for Fidelity. Igor works for Fidelity right now. So Fidelity has all of these rules about what you can and cannot say on social media and things like that. So he can't be out on Twitter, which is, I think, the first place people would look, or on YouTube making content about this stuff. It would be great if he could. You might be able to find interviews of Igor on YouTube. In fact, I think that you can. There's many of them. But he does post on LinkedIn. That's the thing, is like when they're in the business world, they're not really allowed to use social media, but they are allowed to use LinkedIn, and they will post stuff on LinkedIn, and it's really good. There you go. As a PhD student, I get 14 to 15 responses from people who've already done it. That's cool. So, here's an issue I've been running into, and I've tried getting in touch with these people, and I just never get any response, and I don't know how to get them. But maybe there's some of you that are still in school might be able to find it for me. There was a study. Let me find this study. It was about Taiwan. It was day trading Taiwan study. Yeah, there we go. University of Berkeley, California. I remember emailing Terrence Odian because I thought that was the person that did most of it. But I could be wrong. Oh, and because he was in the US. I think I emailed this guy too. These links don't work anymore. This study was a long time ago. When was it? May 2004. This was a long time ago, okay? But these guys, they have a data set. Let's see, where does they talk about the data set? We use a unique and remarkably complete data set which contains the entire transaction data, underlying order data, and identity of each trader on the Taiwan Stock Exchange. With this data, we provide comprehensive accounting of the profitability of day traders through the period 1995 through 1999. So one of the things that people will always say is, oh, okay, when you go through this, virtually all retail day traders lose money. But that must just be because it's really easy to get into and most people give up. So what I want to know is, for the people that regularly day traded through the whole 4-year time period, let's say if they day traded for the first 2 years, how many of them were still day trading at the end of the 4 years? And were they still profitable at the end of the 4 years? So of the people that last 2 years, what percentage of them are profitable? That's the question that I want to answer. And this data set can tell me, and I just need to get a hold of it. So if you know anybody, you know these guys, maybe I should send them an email. In January, remind me in January, we'll send an email to all these guys. Maybe we can find them. I would really like to do this data set and do this analysis to answer this question for people. Because it keeps coming up, and I think that it would be a very, very useful thing for us to know. But I think with these guys, I think that they would totally talk to me, but I'm going to bet that they're like not at those places anymore. Actually, let's do a little searching. How much time do we got? 25 minutes? We're good. Okay, well, it sounds like he is still at Berkeley. The actual retail price of equity trades. Disposed to be overconfident. Oh, that's interesting. I've never read that one. Retail trades positively predict returns but are not profitable. Oh, yeah. No, if you go to... there is a Speculator Seth LinkedIn page. You can find me there. And then from there you can, I kind of don't like the way that they do pages because I think what you actually want to do is follow me, because then you can see stuff that I'm liking and commenting on, and then that's a really good, it gives you a really good idea of where you want to go. Okay, so here's something Jean-Philippe posted 5 hours ago, and when he posts something like this, it usually means there's a piece of research that he's working on, or is kind of, so this is kind of some of the most cutting edge stuff that we can possibly find. Classical economics posits that rational agents make optimal decisions, often as a result of complicated mathematical calculations. This is implausible, to say the least. A way to possibly save the rational expectation paradigm is to argue that agents are able to learn best responses from past experience. Yes, agents are only boundedly rational, but they learn, and in the long run, they act as if they were rational. While seemingly reasonable, this proposition is by no means guaranteed to be legitimate. In our recent paper with Garnier Brun and M. Baquien, and then he has a link to this. Here's a PDF. Okay, but I'm going to search these guys' names. I'm going to do that right now before I forget. Oops. Let's get rid of the J dot and just say Garnier Brun. There he is right there, PhD student in France. And I can come in and see, is he actually active on LinkedIn? Not too much. These guys are French. They're all French. Yeah, I won't add him because I won't be able to understand anything that he's saying. Back to the thing. Okay, we argue that even in a completely static environment, agents are unable to learn collectively optimal strategies and must do with satisficing. I don't know what a satisficing solutions, as argued long ago by Herbert Simon. Within our stylized learning model in a complex world, we find in particular that long memory of past rewards is beneficial to learning, whereas overreaction to recent past is detrimental and leads to cycles or chaos. Increased competition destabilizes fixed points and leads first to chaos and, in the high competition limit, to quasi-cycles. Some amount of randomness in the learning process, perhaps paradoxically, allows the system to reach better collective decisions. That's what I freaking love about this stuff. Is it's always like the chaos actually helps the markets. Right? That's always the finding I find. On the positive side, the learning process allows cooperative systems to coordinate around sacrificing solutions with suboptimal average reward. However, hypersensitivity to the game parameters makes it impossible to predict ex ante who will be successful. Oh. That's very, very interesting. So I got the PDF and we can go read that later. Martin Braun, in a pitch black night somewhere in the outskirts of Laos, Nigeria, I was sitting in a car with the driver, a potential new cocoa supplier, 2 strangers and a bag of money, and I knew it was all wrong. The car was nearly falling apart, and I saw mostly bare metal inside with lots of exposed wiring. Lights were flickering inside and out, and there were no seatbelts. A thick, warm breeze blew into the car from all open windows, and no one said anything. Good grief. The driver was a very big guy, too. Too big for the car, and his head hit the roof, so he struggled to keep his head straight. I thought, this guy is piloting us in his motorized coffin and on an unlit road in a part of Laos which looks like the apocalypse has struck. Two strangers suddenly entered the car at a stop. My assessment was that they weren't representatives from the Laos Tourism Association, so I asked my supplier who they were. "Don't worry about it, we bring them home," he said. Gosh. The supplier was a peculiar guy. He was pushing hard to do business with us and proposed to give European real estate and his car as collateral. He showed me his operation in Nigeria and his bookkeeping, which was based on piles of wrinkled papers stacked in his office, which looked more like a truck repair shop. In Africa, you need to keep an open mind, but this was stretching it. The bag of money is something I was used to in Africa, and traveling with it is uncomfortable as it makes you exposed to robberies, especially when you are not in an armored vehicle. The situation felt unreal, and I felt literally really far from home. It was as if I had an outer body experience where I looked at myself sitting there moving in a dark void of nothingness and being dependent on people I did not know. I felt more vulnerable than adventurous. Now I had young kids. I could not just get out of the car in the middle of nowhere and walk into the abyss. I felt being an easy target, so I decided to just sit and hope for the best. After about an endless hour of driving, we suddenly ended up at the gate of my hotel, which was a great relief. I got out of the car, shook the hands of my supplier, awaited the guards to open the gate, and walked into the hotel. And it was the last thing I have ever seen or heard from my supplier. Vanished like liquidity in the cocoa market. What a freaking story, man. So I didn't really learn anything from that, but that sure was a good story. Oh, you were born in Nigeria, in Laos, Nigeria? Wow. Lagos. So maybe you can explain something to me then. I don't know if there's anything to explain, but so like if I go to maps.google.com, and we come over to, okay, so where is Nigeria? Nigeria is right here. Gotcha. Okay, so my understanding about Africa is this, that most people live here and like around here. Is that accurate? I want to understand why the population centers in Africa are where they are. I guess Kenya and Uganda. I had a friend from Tanzania when I worked for Goldman. 25% of the entire African population is from Nigeria? Really? Are they, well, so I understand that there are rivers over here. I guess there's a bunch of lakes and stuff in here. Just birth rate in this location are incredible. That's crazy. It seems to me, so here's what I understand about global demographics and stuff. China is actually kind of peaking, and India is going to surpass it in population growth. And India is likely to see similar growth of massive numbers of people into the middle class, similar to what China has had. That's not a guarantee, but they have some favorable demographics. After India goes, so like right now, the next place to be in is in India. And after that goes, then it's going to be in Africa. And China knows this, and so they've been investing a lot in Africa. But the question, it's kind of remains, which is like, okay, but where will the money actually be? What, satellite. What about these places and stuff? What industries are going to actually be bringing the money and so forth? India passed Chinese population May of 2022. That may be true. I mean, they're constantly revising these numbers, so the last piece of information that I saw said that it's not quite there yet. Well, in Nigeria, they have a bunch of really big rivers and stuff, right? Anyways, maybe you guys will post more information for me here about population and trends in Africa. Let's keep reading. You need to understand this if you want to make money from options trading. Yin and yang, skew, and term structure dance in tandem, shaping the options market with their unique interplay. Like, did you see that, like, almost everything on... So I don't think I necessarily could get too into... I mean, it's options. I don't know if I'm going to be doing anything with options anytime soon. But I could go into it, and I could learn a lot from that, right? I highly recommend this HFT text. It provides a succinct overview of current and projected HFT best practices. It's a quick read, and it covers trading strategies, HFT architectures, matching engines, Linux performance, network protocols, optimal use of L1 through 4 caches from an application perspective. Yeah, I've dealt with that stuff before, actually. Microwave technology for arbitrage, optimizing C++, Java, Python for dev and backtesting. Roles of FPGAs for market data. I need to learn about FPGAs. Want to make a better sign back here. Maybe use an FPGA to make the whole wall. That would be cool. And then I could be like the guy on TV, you know, stands in front of the wall and has all the animations and they talk about what the market is doing that day. I plan to use this as one of the texts for my algo trading class at New York University. Oh, I don't know this guy. I'm going to follow him. It was one of my people that I'm following commented on it. Did he comment? Highly recommended. Okay, cool. Oh, wait. What's the book? Oh, he was just linking the class. Okay, so the book is Developing High Frequency Trading Systems. Da-da-da-da. Here we go. Ooh, actually not an expensive book. Well, $42. Hey, look, it's on sale. You can save $2. I will add it to my list. I have a list of Seth books. It's my list. Okay, 10 minutes until the news. Let's see here. Tactical tenacity. Well, there's a lot of Nigerians in the diaspora all over the world like myself, and they marry other races and their offsprings now have African heritage. So I think that's probably why. Not sure. Okay, what's an FPGA? I think FPGA stands for like fully programmable. Let's see here. FPGA, field programmable gate arrays. Okay, so this is actually super interesting, guys. Oh my gosh, I can't even. This is like hyper nerd stuff. Okay, so an FPGA is basically a processor that allows you to program the hardware. So, like, you know, I could go and I could write an algorithm that does a certain thing, and then I'm running it on my processor, and my processor is kind of generalized. So my processor might not run it as quickly as if I can get, for instance, an ASIC. Like, you know, in Bitcoin mining, they use ASICs. They have these computers that are built specifically to mine Bitcoin, and they are significantly faster than trying to mine it on your CPU. Okay. Well, what an FPGA does is it allows you to get some of those benefits of an ASIC. Basically, there's these gate arrays, and you can program these gate arrays, and that basically makes circuits in the hardware that can do certain things. So if you need something to happen extremely quickly, FPGAs are sometimes the best deal for it. And that can include in high frequency trading, that if you have an FPGA chip on there and you have it doing some sort of a calculation or something, that you might be able to do it faster than everybody else because of that. Or if you're in the Arduino world, you can use these FPGAs to do things that like really require high latency, like driving a light board like this, like a large TV screen sort of thing. So that's what those are about. I'm hearing some clicks, so I'm kind of looking here at the treasuries to kind of sort out what they're doing. I think that the clicking is just coming from the S&P 500 really, really rallying hard here on the open. So I don't know if I kind of feel like they didn't really do too much with the news, but these freaking kids. Last night, I woke up in the middle of the night and Ethan was kind of like, and he was like half off the bed. He didn't completely fall off the bed, but like half of him was off the bed. And they both, they're laying there in the bed, and they're like, one of them is like completely upside down. It just look ridiculous. Okay. Will you be trading on Christmas Day? Hell no. Yeah, so this is a prop traders. Those guys are probably not actually prop traders. I hate how like we've turned like these combines and like whatever you want to call them, funded trader programs. We call it prop trading now, and that's not what prop trading was before. Martin Braun, my price prediction for Bitcoin is 5 million per coin in 2024. All those other predictions from amateurs like Michael Saylor, Kathy Wood, Tim Draper, and Mike are meant to lure you into selling your coins. They are bear traps. FUD. Don't believe these pundits. They have not done the work. I think he's joking around. I don't know if I will read the whole thing. Your despair is over, and your holding will be rewarded when you take BlackRock out of their misery in 2030 at 1 billion per coin. That is the true fair value of this transformative technology. And anyone who tells you differently wants your coins or hasn't done the work. He's been very anti-Bitcoin, so I'm pretty sure that he's joking around. Cumulative returns are often showcased in trading strategy performances, but can be misleading. These returns aggregate gains and losses over time, presenting an oversimplified view of a strategy's effectiveness. They mask the volatility and drawdowns that occur along the way, aspects crucial for understanding risk. A strategy may show impressive cumulative returns, yet conceal periods of significant loss or high volatility, which are critical for any investor's risk tolerance. Therefore, while cumulative returns can offer a broad overview, they should not be the sole metric in evaluating a trading strategy's success. A more nuanced approach in considering maximum drawdown, Sharpe ratio, and other risk-adjusted measures provides a clearer picture of a strategy's performance and sustainability. Nothing too advanced, but a good piece of information for us. What's your opinion on crypto? My opinion is that if they approve a Bitcoin ETF, which they really shouldn't, but I'm getting a lot of information that suggests that they're going to. If they do approve a Bitcoin ETF, that should probably increase the amount of money that can be put into Bitcoin, and it probably will, in general, cause the price of Bitcoin to rise. I saw some analyst, I talked about this at the beginning. There's an analyst saying, we think that the ETF being approved could be like a top. Well, it might be a short-term top for sure, because there will be some people that are like waiting for it to happen. And when it happens, then they'll take their profits, right? But I think over the longer run that it will help Bitcoin's price. But there are also some really big risks. There are still some really big active enforcement actions out there. And we've even kind of got some hints that they are investigating and or looking at doing something about Tether. And if they did that, you know, and Tether fell apart, that could really, really harm the Bitcoin ecosystem and cause massive, massive losses in Bitcoin. So as always, there's great rewards and great risks involved in getting into Bitcoin. I don't think it's very effective for day trading. So if you're going to do it, I would just buy and hold. But I do not believe that Bitcoin is a positive thing for humanity. I think that it increases criminal activity. I think that it would be a very bad thing for the economy to be based on Bitcoin or to have exposure to Bitcoin, because it is a volatile asset and will always be a volatile asset because of its very nature. And I think this is something that people don't understand. They think that, oh, the more people that will use it, it will become a thicker instrument. But it will never get to the levels of volatility that it would need to be usable as a currency, not to mention its deflationary nature. So I don't like it, and I don't want anything to do with it. So even though I would say that my prediction is that it's going to go up, I'm not going to put my money into it. And I've kind of been actively avoiding talking about Bitcoin, because I could probably build my channel up really big talking about Bitcoin. Although I think that YouTube kind of, for a while, Bitcoin was a big thing, and then YouTube kind of clamped down on it. So maybe it's a good thing that I never got into that. I live in the UK, and Bybit and Binance both pulled out due to crazy strict regulation. Yeah, and the whole question is like, okay, what is it that they're doing that your normal exchanges aren't doing that they don't want to be in it? Whatever it is, it's not something I want to be involved in. Okay, so here we're about to get the consumer sentiment numbers in about 45 seconds. Martin Braun, the best trades are always surprising trades, not crowded trades. Yes. Ooh, we got to talk about that. Maybe we'll read this. Here we go. Okay, so sentiment was 69.7 in new home sales, lower than expected, 0.59 versus 0.69. But the inflation expectations, let's see here. 5-year is 2.9 versus 2.8, and 1 year is 3.1 versus 3.1. So that is in line with expectations. So I don't know if the market will move too much on that. Those are important numbers. I probably will see some flows come through after this, but no way for me to know what they're going to be. There's nothing in that data that clearly suggests to me a direction. Is your volume based on the RTH? Yes, it's just the RTH. Listen, this is one of those things that drives me crazy. It's like whether it's ETH or RTH doesn't matter, right? If whether it's ETH or RTH matters, you're probably trying to do a strategy that doesn't work. Because what that really means is you really care about what the value area high and low and point of control is or something like that, right? And you just know that once we've been away from an area about 45 minutes, it doesn't matter anymore. So the volume profile is useful to watch the volume as it builds up. And I don't really care what it was doing before I started trading. Unless it did something like just before the session opened, right? Okay, I'm going to read this article, this post here. When I was trading cocoa, I always forced myself to think, what trade is no one expecting, but is possible, and who could do something like that? It's a version of thinking, what if I am wrong, but then looking more specifically for a trade the crowd is not thinking about and elements which aren't discussed by the market. The surprise trade is risky, and setting it up may be highly uncertain, not obvious, and economical. But when a sufficient amount of market participants are sleeping behind the wheel, are parroting each other, being complacent, and sleepwalking into a surprise trap, realizing they are struck, time has run out, liquidity has dried up, and they are not alone, such trades can be very lucrative. In cocoa, I was always thinking the unthinkable, assuming the illogical and unexpected would happen, and often it did. That was also because I knew personalities and former behavior of the movers and shakers in the trade, many mavericks and massive risk takers, and sometimes in breach of good market conduct, I have fought against for years in the ICAG with regulators. A crowded trade is doing the opposite of a surprise. It is positioning basis information which looks obvious because the crowd is talking about it day in and day out. The problem with this is that the crowd becomes an echo chamber with confirmation bias, and worse, people or data conflicting with the trades are neglected or brushed away. Confidence has become arrogance, superiority, and lack of respect for the other side of the trade. Such sentiment, which is also not intelligent, often leads to people's faces being ripped off eventually. The markets often aren't nice to the crowd, to the masses. Life just doesn't work that way. From my friend Google, crowded positions develop when investors become so convinced of the logic of the position and its likely success that they become complacent. Crowded trades are dangerous because if anything occurs to shake the faith of these investors, efforts to bail out can be highly disruptive. Few others are left willing to take the other side. Crowded trades begin to unwind when some participants become concerned, break rants, and sell their positions, fearing that they must act before others do. Crowded position generally happens when a trade becomes wildly popular and gets adopted by a huge number of investors who are all betting the same way. A crowded trade has a large number of participants on one side, which greatly increases the risks of a squeeze. Crowded trades are easy to spot nowadays with social media. The lack of doubt about positions and expression of pseudoscientific certainty combined with arrogance are very clear signs. Professional trades, even with high conviction, always have doubt. Welcome opposing views, and absolutely none of the best traders I know are arrogant. They are humble. So this is, I think, a very useful thing for us to think about right now, because this whole time, the past month, I've been going like, okay, we've risen back up. I would expect us to rise back a little bit, but I think that the upside should be capped a little bit. And I don't think that the Federal Reserve will be able to bring rates down very much next year. Maybe they will do 1 or 2 rate cuts in June, but right now the market is predicting 3 and that they'll do it in March. I'm very, very skeptical about that. But I didn't realize how off with the market I really truly was, because there was some surveys, like, what strategy are you, most confident in next year? What's like your best trade? Basically to say, what is the biggest consensus trade of 2024, at least the beginning of 2024? I can remember in 2022, 2021, something like that, when the consensus trade was short the dollar, and then we had this huge rally in the dollar over the last year or so. So what is the consensus trade right now? It's long treasuries. They all think, they're all very positive that the Federal Reserve will cut rates and that treasuries will move up considerably. And I'm not going to say that the consensus trade is always wrong. I don't think I've ever seen that the main consensus trade for the year end up being right. I think it almost always gets blown up. But I would say I've definitely never seen it where the consensus trade makes tons of money. Everybody's already in it. It's hard to make money, right? The real money is made when you're against the consensus. And so I think that we could have a good opportunity this next year if because I just don't think this is going to play out the way that the market wants it to. If the Federal Reserve starts cutting in March, then by the time presidential election comes along, you're going to start having inflation concerns again because this economy is still a little bit too hot and inflation still looks entrenched. So that's probably going to be a big theme of next year. We'll see how it turns out. In the meantime, probably don't want to fight it, right? They want to buy treasuries. And they are doing all of those sorts of things where it's like they ignore everything that goes against it. It's like it just only seems to be able to go one way. I'm just browsing LinkedIn to see if there's anything more on there. I'm not really seeing anything too interesting. I think we already read the most interesting stuff. Really, I want to get a hold of this Odeon guy. I don't know. Oh, he has videos on YouTube. Oh, wow. He has 2,000 subscribers. Interesting. Well, maybe I need to try again. Probably should mail him at the start of the year, not going into Christmas though. So I'll write myself a little note here. Tactical tenacity lagging up. Yep, I will see you guys next year. Yep, we will not be. This is the last day. I know it's going to kind of be an anticlimactic one. And those kids, they're still sleeping. You think that they'll make it all the way through the stream? We get to the end of the stream, I'm waking them up. And I'm going to decide what we're going to do. Maybe I'll call my mom because they're off. Maybe they'll have some fun ideas. I don't think I want to stay home. Not that I don't want to stay home, but like I want to take them places. I don't know. We'll see. We'll see what happens. Okay, well, let's check out Zero Hedge and see what we can learn about those numbers that we got. New home sales crash in November despite plunging rates. Builders hit a wall with subsidies. A silent depression already started in the United States. Okay. U.S. durable goods orders surged the most since July 2020, but the GDP driving core capital goods shipments growth was the slowest since February 2021. Gaming stocks plunge after Beijing unleashes. They didn't launch, they unleashed a surprise crackdown. I find it so interesting what the Chinese government is doing in relation to gaming and so forth. Like, they're that concerned about it. I mean, because I would just like, kind of shrug it off as, well, they're too, they're just old people. They don't understand, right? But like, to go to that length, they must have some really good reasons to think that they need to do that, because otherwise it would be like so harmful. Like it would be not harmful, but I mean, like, how do you keep a lid on that? Like that's the sort of thing that would really foment dissent. White House hysteria, new dominant theory apartment won't stop with Ukraine. Well, of course he won't. Of course he won't stop with Ukraine. This idea that like he only did it in Ukraine because the U.S. provoked him into it or something is total nonsense. That he will attack anywhere that he thinks he can get away with. Julian Assange likely to be his last appeal against getting extradited to the United States. You know what? I think that Julian Assange and Edward Snowden and all these guys, I think that they should come to the United States and they should stand trial and they should defend themselves to the best of their abilities and let the cards fall where they may. And then after all of that is done and we've learned everything that we can from the courts about legal and on all of that sort of stuff, then they should be pardoned. Yes, I think so. I think they should pardon them, but I think that they should stand trial first. Because, for instance, with Edward Snowden, he did provide us with information that I think that the public had a right to know, but he maybe did it in a way that was not legal. And so, like, we need to learn where the boundaries are and the specifics of this are. And I think that it would be beneficial to have the court case. Treasury's kind of selling back down here since the news. Wouldn't say that it's huge, but it is about 4 ticks down. We'll see if they decide to go for the lows again or not. Okay, so government wage growth hits record high as Fed's favorite inflation indicator tumbles. One of the Fed's favorite inflation indicators, the core PCE deflator, tumbled to 3.2% year over year, below the 3.3% expected and down from a downwardly revised 3.4% in October, the lowest since April 2021. Headline CPI also slowed more than expected to 2.6% year over year, down from 2.9% in October. The headline PCE deflator fell, and the drop was all driven by goods, both durable and non-durable. On a 6-month annualized basis, mission accomplished. Even more focused is the Fed's view on services inflation ex shelter, and the PCE equivalent shows that it has broken down from its sticky levels to its lowest levels since March of 2021. Year-over-year goods inflation continued for more than a 6-month in a row. Both income and spending rose month-over-month in November, which pushed the year-over-year spending and income growth even faster. Savings rate ticked up on the income side, it's all government-driven gains. Private wages are up 5% year over year after 4.1% in October, which was the lowest in 3 years, but government wages were up 9% year over year, matching an all-time high. Finally, while the markets are exuberant at the disinflation and the coming Fed rate cut avalanche, we do note that it is not all sunshine and unicorns. The vast majority of the reduction in inflation has been cyclical. Acyclical core PCE inflation remains extremely high, although it has fallen from its highs. So, is the apolitical Fed really going to cut rates by 160 basis points next year with this background? Probably not. I don't think so. Okay. AXUFX asks thoughts on NQ. NQ is the widowmaker. I see more retail traders blow their accounts trying to trade NQ than almost anything else. I also see more naive beginners gravitating towards the NQ more than anything else. I think that what it is because when you calculate, okay, how much does this thing move in a day and how much money would I make based on the capital that I have? NQ always ends up being like the best bang for your buck. But the thing that you don't necessarily realize is that the greatest gain potential is also the greatest loss potential. And so what usually happens is they almost immediately blow their accounts. I would say that NQ is a very advanced instrument. It's very quick. It is very difficult to trade. You have to be very fast. And it's an index, and indexes are kind of random. So it's kind of hard to really get a good edge and like good consistent winnings from an index without taking on a lot of risk and having like a really fat-tailed strategy. So I really don't feel that NQ is really very well suited, especially for beginning traders. And that's why, again, I see more people blow out on that than more than anything else. If you absolutely insist on trading an equity index, I would trade micro ES contracts. But I think that you would probably have better chances of success by either trading the treasuries, like the really slow, like ZN, or finding a pure commodity like oil, gold, copper, corn, and any of those and trading those. I just asked myself, I lost it all in NQ, and then I lost it all in QQQ. NQ is dangerous AF. It is. It is the Widowmaker. Like, if there is an instrument that's the Widowmaker, it's NQ. Don't get me wrong. CL is a you know what. Okay. CL will play tricks with you. CL will be like, oh, dude, you totally know what's going on here. Like, look, you're making so much money from just trading this and these trends and stuff. And then it will just do something paradoxically stupid that just doesn't make any sense at all and completely blow you out. It plays games with you, draws you in, and then takes all your money. CL does. But NQ is like chaotic evil, right? Like, it's just gonna go wild all over the place and make money or lose you money one way or another. And it's just, equities do that more than what do you mean do that? I tell you what, there are some advantages to trading equities. So if you're a small trader and you want to take small risk and you want to be very, very involved in the markets, then I think the futures are a better place to trade and to day trade. But there are some places where you can kind of get some advantages in stocks, especially if you have like access to the book. You can scalp over there and you can make money. There's a wider spread, so there might be a little bit more room for you to make money from doing that sort of thing. There's also, you can choose what you want to trade, and so you can always go into a market that is favorable to you that day. There's some things about stocks that are very favorable, but you have to have more capital to start out with to even get into day trading. And then even then, like, you might need to also, like, if you're going to scalp, one of the things I've seen a lot is people want to take all these teeny tiny little trades, and they're taking like 100 trades a day or something like that, right? And if you have not like pre-filed with your taxes to be able to pay your taxes on like the net profit of it all, then you're going to just get absolutely screwed over by the wash trading rules. So you got to be careful with that. Not going to lie, though, ES has a very attractive margin requirement for most futures brokers. Well, yeah, but I mean, doesn't ZN have a very... So, like, here's what I don't understand is that if you come over here into ES and you're trading micro ES, so to make... So if it goes like 4 to 8 ticks, that's going to be $10, right? So if I get it to go 3 points, then that's going to be $15. 3 points. And that's decent. That would be from like 16 to 19 here. Okay. So that's pretty tight for the volatility that we have today, but I'm sure that there are a lot of people on the micros that are taking like, you know, $15, $20 profits. Okay. And I would say that that is about on par to taking a tick out of ZN, and that's $15 too. So why ES? Because it moves around a lot, I guess. But I don't really think that it moving around a lot is necessarily a good thing. If it's moving around a lot and it's mostly noise, then that's just a lot of random movement that does you no good. Versus ZN doesn't really move significantly unless there's a really good reason for it. No, we did talk about that guy in Discord, though. That's a little bit different. Reacts to volume, if you say so. So one of these, it's a funny subject, I think. Like, define reacts. Like, so if I wanted to write a study that would get published in a peer-reviewed journal, which says ES is favorable to this trading strategy because it reacts to volume at price, how would you prove that? How would you quantitatively prove that ES, quote, reacts to volume at price? Because I can come in here and look at it and be like, okay, here's a number that I think is important. The 116, this is a point of control. You know, well, I think when it gets there, I'm going to see some sort of, quote, reaction. Oh, okay, look, a little bit more volume traded there than usual. That must be a reaction, right? But is it actually a reaction, or is that just me, like, confirmation bias? Like, I'm looking for something, and so somehow I find something that suggests to me that that its volume is reacting there, right? And I have no way of saying, like, what is that reaction? And is it truly actually statistically significant, right? And there's a lot of that in trading. It's the same thing with support and resistance lines. Like, if you go and you, like, quantitative, if you say, okay, look at where it bounced before. If it bounced at a price more than twice, then I want to buy there at that price again. Give it a certain risk reward, etc., etc. You do the trade, right? You program that up, it won't be profitable. Almost guarantee you it won't be profitable. So then they'll say, oh, well, it's because they know that you're trying to get in there at that location, so they're going to push it a little bit further than that to stop you out first, and then it's going to go up. Okay, so that means that I can't just trade it on the line. I can say it can actually go a little bit below that line first, right? So how do you quantify the effectiveness of a line? How do you come in and say the market reacts to this line more than it reacts to this line? I think that 50, 100, 200-day moving averages in the S&P 500 seem to contain some sort important consequences for the markets. Like markets seem to behave differently around those, and when they're above or below, like things shift. But like, how can I prove that? I have no way of proving that. You know? So when I hear people say things like, well, I like ES because because what you're saying is common, right? What you're basically saying is traders that believe in volume profile trading setups like to use ES. They do, because ES has interesting looking volume profiles. But every time that I try and backtest something based on that, it says that it doesn't really work. There's a non-quantifiable discretion also. Well, so this is another issue, is that I can come in and I could say, well, support and resistance does work, but you have to exercise discretion. Okay, so what exactly is involved in that discretion? Well, part of it may be I know what the news is that day, and I can just kind of guess which way it's going to be going based on the sentiment and the news and all of that sort of stuff. Okay. Well, how do I know that the profits from my strategy aren't coming from that? How do I know that the strategy with the volume profile and the value area high or whatever it is that I'm looking at is doing anything for me? Right? If I can't take a strategy that's just using that thing and prove that that's profitable, then what makes me think that adding all of this other stuff is going to make it profitable too? Right? Or sorry, if I can't make it profitable on its own, what makes me think that adding all of this other stuff will make it profitable? Right? And then if I do add all of this other stuff and I make it profitable, but then what if I take everything out except for like this new thing that I added in, and then that's profitable? So then does that mean that all of the profit just came from that one thing that I was doing and that the volume profile had nothing to do with it? Right? So it comes back to people believe certain strategies work. Why did they believe in those strategies? Because there's no actual empirical evidence to prove that they work. They heard from a trader that they respected or believed, and they learned that thing, and they're basing everything off of that. And you have absolutely no idea, really, whether any of it means anything. Because I can just come in, I'm telling you, I can just come in and come up with some theory of how the market works that and make it sound really attractive to people and sell people on it. All you got to do is just put like really big numbers up on your YouTube video thumbnails and people will click on it. Okay, so I am seeing one child moving around. I might just shut things down now, unless you guys want to go down. Non-quantifiable discretion. This sounds so woke. Oh, jeez, come on. Don't play him dirty like that. What I like about spot gamma in the option flows and such info, as in maybe it works with those zones or something. Ah, okay. So now you're talking about something very, much more interesting to me. Okay. There is something to options gamma, which is that we can actually describe through logic and our understanding of the way that the market works, why moving through certain prices based on gamma might predict future orders, right? Now, have we proven that it predicts future orders? I'm going to say not strictly, but I have seen a little bit of research on that, and I think that we have pretty solid reason to believe that it does predict future orders, okay? So let's just say, though, for the sake of argument, that options gamma is like an empirically proven, stylized behavior of market that arises from the dynamics involved with spot gammas and stuff like that, right? Okay. Does that mean that you will make money from it? Now that's the interesting. That's the more interesting thing, because that's where we're at too. So I can tell you all of these things about the stylized behaviors of markets, things that we can prove about the way that the market behaves that are based on the very rules of the game, not based on like what people tend to do, but the rules of the game lead to these mathematical behaviors that we've discovered. They are very difficult to suss out, and it took them many, many years to find them, but we know that they exist. But can you then, combining that with what you know about the market that day, information from outside of the market that is specific to that day, and can you combine it all together in a way that is profitable? Well, there's no way to prove that, right? Because now we're talking about that one instance. It was you. Because even if we say, okay, here is the strategy that does appear to be profitable, will you be profitable with it? Is it still profitable? There's no way to know, right? So it's this interesting conundrum where, yes, we want to base our trading on empirical evidence. I think that the main thing is it comes back to the learning, right? You're watching the market, and as you watch the market, you're learning things, and your mind is making all of these conclusions and taking all these lessons from it. But what if it's just random? Then you're building that into your neural network, and that could potentially harm your future learning, right? So we want a foundation that is based on empirical evidence, but at some point in trading, there is always this place where the rubber meets the road, where you have to take a leap of faith. And so I find it ironic that trading, that being successful at trading, or at least what we know about it, suggests that you need to both rely on empirical evidence and take great leaps of faith. I think that what happens is most people, they miss the first part. They are working completely on faith. They are trusting something that somebody else told them, or there was just something about that indicator that kind of spoke to them, and so that's why they're interested in it. And they have absolutely no empirical evidence behind any of their foundation, right? Versus if everything had to be proven, if everything had to be empirically proven, we would never be able to trade. Yes, faith is weirdly key. Oh, my empirical edge is wearing my 1940s cowboy hat. If you really do wear your cowboy's hat while you're trading, that's boss. I hope that someday, when I've become a multimillionaire trader and they're making an inspiring Hollywood movie about me, and I'm played by Timothy Chalamet or something like that, I hope that they have you guys in there too, and that one of you is wearing a huge cowboy hat every time that they show them trading. Because that would be great. I got to tell you, some of the best futures traders that I've met always kind of have an agricultural bent to them. Like they're people that live out in the middle of effing nowhere and are like almost literally cowboys. Kind of have that southern twang a little bit. And I knew this one guy, and he, I don't know how profitable he was, but I saw him take some pretty big trades. I remember one time he bought at somewhere, and I didn't really think it was a very good spot. I didn't like what I was seeing in the volume there. He bought, and it came down, and it went so against him. It went like 16 ticks against him, and it didn't bother him at all. And then it came back to where he got in, and he took like a 1 tick profit. I was like, holy crap, dude. And he talked like Larry the Cable Guy. Like, like he had some money to do it. He had been doing it for a while. He had made some money from doing it. I don't know if he was long-term profitable, but he had made some money from doing it, and he talked like Larry the Cable Guy. He was always fun to talk to. Okay, well, you know what? Ethan is awake. I don't know if I really have all that much to share with you guys from here. So I'm just going to shut the stream down. I will see you guys next year unless you're on Discord, I'll still be around. So if you want to talk or you have some ideas or something, hit me up in Discord. I'm going to be spending the majority of the break studying for my Series 3 exam. Hoping to maybe do 2 a day, maybe. Also, I'm going to be building my Kubernetes cluster, kind of getting some of this machine learning stuff up and going. Trying to get a voice-activated assistant as kind of the project. So I'll be here working. So if you hit me up on Discord, you'll probably be able to get a hold of me. And I'm also writing a video, so hopefully I record that in the next week. And then I will see you guys on, it'll be the 2nd this year, right? I think so, yes, because the 1st is a Monday, so it will be the 2nd. So until then, stay